All right, Yield Nerds episode 159. And in this episode, I will be doing the unthinkable because the world is up and it is uncertain. I will be doing the unthinkable. I will be questioning the sacred cow of the United States fixed income market. I will be questioning whether treasuries and agency bonds are really safe. Dolly, when I ask for a sacred cow, don't bring me a bull. This thing confuses me. Anyway, let me go to the next part. We are at 459 subscribers. Thank you for listening. There are three playlists. Please look at the roadmap if you want to look at the show in a sequential order where I begin with the beginner level for fixed income and take you up to today. Most importantly, do not just believe what I say. Do your own homework. I do not have any magical powers. Well, four parts in today's episode. First is the market temperature as I go against the sacred cows and throw my boomerang to understand what is really going on. And then we'll play my favorite game, the Yield Super Bowl. And when it comes to my investment thesis, I now have proof that Chairman Jerome Powell watches Yield Nerd. I'm going to tell you why. And finally, I will talk about my holdings. Well, my portfolio continues to absolutely demolish the NASDAQ and the rest of the market. I have positive returns for the year. I'm up almost 1%. The market is down 7, so good things happening in that world, but that is mainly because I've stayed in fixed income. My equity portfolio, after the Cal Maine Foods debacle, has recovered very nicely, and I'm again inching towards positive outcomes there. I'm down 2% on equities, but still far, far better than the NASDAQ. And I'll tell you why and the choices I made. The most important choice I made is to stay 99% in fixed income as I tried to predict and understand this instability. However, 99% fixed income is also a concentration risk. What if treasuries and agency bonds are not secure? That is my big fear, and that is why I dive deep this time into what can shake that cage. Well, let's first play Eel Super Bowl because there is something here that scares the living daylights out of me. Before I go any further, I want to make sure that you know that I am not a wealth management advisor. This is not investment or tax advice. This is my education I'm sharing. You should do your own homework. Well, I keep talking about this frothy market, and the frothy market doesn't make a sacred cow feel very safe because we got tariffs, we talk about flexibility, there may be a re-escalation, there is still the Ukraine war, we don't know exactly where the unemployment numbers are going to be, who knows where the interest rates are going to be. This is a lot happening. And when so much happens, and I've kept saying this many, many times over, the market doesn't like uncertainty. If there are going to be tariffs, if we know there are going to be tariffs, here is the amount of tariffs, the market will deal with it. The challenge happens when there is unemployment and tariffs and interest rates. It creates a lot of stress, and stress creates volatility. And if you're a smart yield nerd, you will use that volatility to your advantage. And that is what I am trying to do. Chairman Powell watches Yield Nerd, and here is how I know it. I've been talking about uncertainty for at least 4 weeks. Thank you, Chairman Powell. During his last address, he used the word uncertainty 22 times. So thank you for watching Yield Nerd, Chairman Powell. I will give you more intel into special words and trends. Just kidding. So let's actually quickly look at how the yield curve itself has changed, because there's a little bit of fascinating changes going on. In 2023, we were north of 5.5% short term and approximately 5% in the 3 year. And then in 2024, the entire curve maintained its shape but fell by about 1%. Since 2024, when you start looking at 2025, the tail has started increasing. That's what we call bear steepening. And the front end is still kind of high, which is good, so you can make a reasonable return. However, one would say, hey, you know what? We no longer have the inverted yield curve. That probably means there is no issue about a recession. You can believe whichever side of that argument you want to believe. Is there or is there not a recession that is impending? But if you zoom into just the curve for March 2025, remember this is January 2025, the inversion has left the room, and you're sitting here cheering, saying, woohoo, no recession. We have figured out a soft landing. And from January to March, watch out. This is the March 2025, the yield curve from yesterday. We no longer have a yield curve, we have a yield cup. And I have never seen this in the 3 years of Yield Nerd that I've been doing. This is uncharted territory. What it is showing is that the long end is coming down, but not coming down as fast. The medium end is kind of sort of keeping where it is. The short end is still falling slower than it should. And that, there is no guidebook. There is really no guidebook for what to do in such a scenario. And that is why I develop a guidebook for me. I'm going to share that with you, and you do you. So if you overlay 2025 over the other two curves, what you are seeing is you are losing some advantage in the short term. The middle part of the curve is kind of sort of settling down, and the tail end is showing signs of increasing. So you have to make your own judgment call of where do I go with that. Yield Super Bowl, I've made it literally jumped right to the conclusion. You should watch previous episodes to understand what Yield Super Bowl is. This is the pre-tax yield. And so I tax adjust the yield, and I also adjust it for marginal taxes. So please watch previous episodes if you don't understand. And if you sit here and say, wait a second, treasuries don't pay 4.5%, again, pre-tax yield, I add back the state tax. So here is a dramatic conclusion. Everything except the 3 month. In the 3 month, the treasury beats. Everything except 3 month, corporate bonds absolutely crush yields on a pre-tax basis, and you go, wow, I should go load up on corporate bonds. And so I started looking at what are these corporate bonds paying 5.5% and 6%. I'd like that. And once I started researching it, it turns out the corporate bonds that pay 5.5% and 6% in the 5 year, 7 year time frame, these are all, and this is a 10 year, these are all financial sector bonds and international. So here is Deutsche Bank and here is National Bank of Canada. And so I thought, okay, well, let me understand what these two fixed income securities are all about, because if they pay 5.5%, 6%, and Moody's thinks these are AA2, A1s, that's a sweet deal. I'd like to lock in 5.75% yield for 10 years. That sounds lovely to me. And so I started reading the prospectus of the Deutsche Bank, bond. Now realize that it is not governed by the SEC in terms of the rules. It's governed by Germany, by the government of Germany. And so I started reading more about the European Commission and what their rules are. And I came across this little tiny footprint in the prospectus that said the ECB has a regulation called SRM, which is their securities, regulation, and there are special resolution measures, SRMs. And if they come together and they say, Deutsche Bank is in trouble, so we're going to do a quick thing. We're just going to write down the outstanding bonds to zero. They have the right to do that. I don't know whether they will or not, but they have the right to just wave a finger and take out the indebtedness. They also have the ability to automatically convert your bonds into shares of Deutsche Bank, or they can convert your bonds into shares of any group entity or any other bridge bank. And as I started reading more and more about it, it made me a little bit nervous because you have no control over this. The ECB has control over it. And given some of the tariff climate, if somebody wanted to punish an American investor, the SRM can bite with a lot of teeth. And so it made me nervous. So I said, you know what? I'm going to go read the Canadian bank's prospectus and see if I can come to terms with that. The Canadian bank also has a program, they call it bail-ins. The Canadian bail-inable notes also have the same privilege. They say, hey, if the government of Canada says we're going to invoke our bail-in privilege, then we can convert all of our bonds automatically into common shares of this bank or any affiliate or anything we think and wipe it off the books. And again, nobody is saying any of this would happen. All I'm pointing out is that when you're buying a foreign security, you are going to kind of be beholden to a foreign government. A lot of these are friendly governments and they have a good democracy, so you would hope they don't wipe a foreign investor out. But you have to realize that you have no choice. You have to accept the common shares, even if you think that is not an appropriate investment for you. Too bad, so sad. That is what will happen. And that's what they say. Some of the National Bank of Canada bonds are not bail-inable, so this would not apply, but others are. So do your own research. So I then took that information and the yield nerd results into creating my investment thesis. And I started questioning, hey, if I don't want to do international bonds, where am I going to park my money for good returns? And I'm 99% in agencies and treasuries, so I better be sure they are safe. So I invited the sacred cow. This one looks too friendly. It doesn't look like a sacred cow, but whatever, we'll deal with it. So I started asking the question, are government-sponsored entities really safe? What if somebody pulls out the G part of the government-sponsored entity? Well, turns out their charter says, hey, FHLBs will get a subsidy. Now, when they say subsidy, it doesn't mean that our taxpayer dollars are going to really subsidize them. What they are really saying is there are two reasons why the FHLB is able to serve the nation and the debt holders of FHLB. One is the common perception that the federal government will come to rescue them. That's one. It's an implied guarantee. Nothing in the law says they will have to do that. It's an implied guarantee. The second is we do get state tax exemptions, and that is a little bit of a subsidy to FHLB and FFCB. And so those are the two quote subsidies. Then the question is, how big are those subsidies and can they be taken away? Well, turns out the subsidies amount to around $5 billion minus 350 million, which is the amount that they pay back. And so then you ask the question, where does that subsidy go? Turns out the subsidy goes right back into the lending organization. So the argument being made is, yes, there is a little bit of a tax credit we give for people to hold our loans. However, we reinvest that and we lower the interest rate for the borrowers. And so all good, nothing to see here. You don't have to take away this alleged subsidy because there is really no subsidy at all. That didn't make me feel very good. I was worried, what if that subsidy gets taken away? So I wanted to understand who owns the FHLB. And once I saw this picture, I came to a very different conclusion. 57% of the FHLB is owned by large commercial banks, the banks that you see on the side of the highway when you drive, all the big banks. And then there are credit unions, and then insurance companies. And once I saw that, I was like, you know what? I don't see how for a few $100 million somebody is going to come take away the subsidy or make FFCB bonds all of a sudden state tax eligible or FHLB. So I kind of started feeling a little bit better. Having said that, I'm not going to risk it for the biscuit for the 30-year FHLB bonds anymore. I like the 5 and the 7 and the 10 years. So I feel good about agency bonds. I just don't want to go really long term yet. Then I have to ask the crazy question, are treasuries safe? To truly get underneath it. And no, this is President Macri of Argentina, ex-President Macri, came up with a brilliant idea. President Macri at that time, I want to say it's 2019. Yes, the article is from 2019. So President Macri said, you know what, this huge amount of debt is maturing. Argentina doesn't have the money to pay the debt. I'm going to come up with a really clever idea. I am going to issue 100-year bonds. And you can just convert the short duration into 100-year bonds. And to make it sweeter, I'm just going to give you a really high coupon. I'm going to give you 8% US dollar, converted to US dollar. And people scooped it up. It was oversubscribed. He issues it, I want to say, in March of 2019, oversubscribed round. Everybody was running hand over fist, paying premium above $100 par. And they said, President Macri, you are a liberal market reform kind of guy. Thank you, thank you. We have faith in Argentina. And when it went live, it traded above par, 105% of par. And it paid 8% in coupons. Wonderful. And a couple of months into it, just a little bit of jitters. And this was done with best intent, so you have to always assume the intent was right. 3 months later, they had to adjust the prevailing interest rates in Argentina to a meager 28%. To you and I, it looks like a shock, but if you have to tamp down inflation, because Argentina had inflation, you had to pay 28% interest. Now tell me, if you can make 28% interest by, putting money into a bank versus 8% by owning a 100-year bond, what would you do? Oops, that bond crashed and it went to 70. Well, what happens when you do 28% interest and you don't have money to pay, your repayments and your currency is crashing? Oh, I'm sorry, we may have to default here. And when that happened, the new president showed up and they said, I'm sorry, we're going to have to default. And that fell overnight to 53 cents or 57 cents on the dollar. All of this in the span of 12 months. And so people who thought they were locking in a high yield for 100 years got a real raw reality. Nothing that would ever happen in the United States, but realized that when there is a huge amount of debt maturing, and there is pressure to decrease coupon payments, there is a temptation to issue really long-term bonds, and be careful about buying those. At least that's the story I take. And so I had to sit here and say, okay, what does it tell me? Even if you sweeten the pot to a crazy high level, the lesson I take is I'm probably not going to go past 7 years. And then I started studying the American reality. So we have a bond market problem. 3 trillion of US debt is going to hit maturity in 2025. So you got to park that 3 trillion somewhere. A whole lot of that 3 trillion is short term. And you got to take that short term and spread it across the 5 and 10 year and so on. So there are 2 problems. We today have a total of, quote, 7 trillion of T-bills, and only 5 trillion is the norm, and the other 2 trillion should no longer be short term, it should be spread into longer term. Tell me what you think will happen when supply increases by 2 trillion and demand stays the same. What will happen to price? Macroeconomics tells us more supply, less demand means prices should increase. In this case, yield will increase. So if you were to look at common sense here, in reality, this predicts that the long-term yield, the 10-year and longer, should go up. And yet the government is very laser focused on decreasing the 10-year yield. So that kind of flies in the face of what could possibly happen. And so what they are saying is, hey, if you spread the 4.5%, 5% short-term bills into the lower priced long-term bills, deficit should actually come down. The problem isn't decreasing deficit. The problem is trying to put it in treasury notes that are the longer term and hoping yield is not too high. And here it is happening in real time. This is the 10-year dropping from what was at 1.5% to lower and lower and lower to 4.3%. So this all says that you should be able to issue 10 years at 4.3%, except how much of it? If you try to throw 2 trillion in new debt on the 10-year, that 10-year is going to go up from 4.3 to a higher and higher number. And that is where an oxymoron lies. So on top of all of this, let me throw another monkey wrench, which is the debt limit. What does the debt limit mean? It literally means after the X date, as it is called, and the references to all of these articles are in the description. After the X date is reached, the government cannot cut one more check, and it will have to start prioritizing what it pays and what it doesn't. Then the question is, what will it pay? And there are articles in the legislation that already say, here is what you can and cannot pay. We did cross this bridge in 2024, where the government could only have paid 73 cents on the dollar, meaning only 73 cents of your coupon, and when returning your par value, only 73 cents of your par value. Imagine that happening. It is a scary, scary thought, but that could happen. However, the Treasury is authorized to prioritize debt obligations first, meaning in theory, the Treasury will first return the entire par, pay the full coupon, and stiff other things such as entitlement programs, federal contractors, military employees. I just don't know how it looks. So you're going to have to tell the military and federal contractors, hey, we're going to pay you 73 cents on the dollar on your salaries because, yield nerds and all of these big banks that own treasuries, we need to pay them the full par value. I don't know how that goes. So I'm hoping both parties come together to move past the debt ceiling. If they do not, then my sense would tell me I should hold some cash because the long-term yields will shoot up. So here's how I'm playing it. I'm keeping a large amount, 60% of my portfolio in short term, looking for that June, July timeframe. I am going to extend duration a little bit because at some point rates are going to come down. And if I owned an instrument that had 6 months, 9 months, 12 months left after rates come down, that should go up in price and I can sell that for a profit. My real hope is that if I sit on cash and there is a debt ceiling problem or the perception of a problem, long-term yields will shoot up and I can jump and get that. I eat my own dog food. Here are two purchases that I made. This is a treasury bill in the short term maturing at the end of May into June, right around the debt ceiling. And here is my agency bond. I am not afraid of agency bonds not being repaid, and that's a 2-year or a 3-year agency bond. Having said all of that, my fixed income decisions tell me the sacred cows are safe. Thank you, sacred cows. But I am going to keep my duration low. So my sense, however, is to not go for international bonds. In terms of US Treasuries, I'm pegging it right around the X date. Agencies outside of the medium term, I'm just kind of laying low. I am going to increase duration after the debt ceiling drama, but we'll see when it goes. So what are my holdings? I still am picking up, nickels in front of the steamroller, as the great Mr. Buffett will say. Anytime I get a profit from one of my equity investments, I sell them. Otherwise, I picked up a couple of new ones. These are all from last week as well. TradeWeb, Ozark, Delcat, Coeur Mining, Natera. These are all ones that are making a profit. And I do have some dogs, some nasty dogs from the AI world, which are all hurting. But they are a minuscule portion of my portfolio, so they don't really rock me too much. Hey, remember to do your own research. Even a broken clock is right twice a day. Thank you for watching Yield Nerd.